have that on. There we go. Okay. Well, hello, everyone. Thank you so much for joining us. I'm glad that you were able to get in, and we are going to get started right away since we're already at the top of the hour. And so we have a very special event tonight. We're going to have a conversation, kind of a talk here. And our main person is Keith Conley, who he's with Wealth Teams Alliance, and he's been a certified financial planner and has been in this field for over a decade. So very, very knowledgeable, loves helping people. We've known each other for a little while. I know he knows 100% of the information. He's going to be very educational for all of us. And we're going to be talking about a very important topic tonight. It's meant for anyone approaching retirement. If you haven't thought about your retirement, you should, of course. And this is just a part of that. But let's go ahead and get started. Keith, if you'd like.
Yeah, thanks for coming, everybody. It's good to see some friends here and some new people. Go ahead and just listen to the presentation. You don't need to share anything. You can just put yourself on no video if you want, but we're going to be talking about why retirement planning must consider long-term care planning. Whether your long-term care plan is a actual insurance policy or not, is an option, but regardless of whether you have a policy or not, you need to have some sort of plan for long-term care. So, as we get started here, this is just information. I'm not your financial advisor. I don't know you. Joan is probably not your tax professional either. So everything here is just education, and there's not any one option that we're recommending to any one individual. So as we start thinking about retirement, the first thing that comes to mind is retirement income. As we accumulate wealth in our 401k, IRAs, and maybe some taxable accounts, accumulating is actually the easy part. Yes, there's always the stock market volatility and risk tolerance, but accumulating the wealth is the easiest part. The hard part is knowing how to distribute those investments in the form of income. That's when things get really, really dicey. Here at Wealth Teams, we are not privy to any one method for generating retirement income, although we do have our favorite methods. But, retired folks generate income, with Social Security as their foundation, most likely. And then there are other options for them to generate income over and above their Social Security, whether that's from dividends and stocks, whether it's bonds and government treasuries, annuities, and we use something we call private capital and first trust deeds, which is a form of debt to help retirees get income. When thinking about retirement distribution, it's as I stated previously, it's very challenging. There's a lot of moving parts. There's a lot of things that could go wrong. There are a lot of things to take into consideration. When I talk to retirees, it is a matter of figuring out how long it is they want to retire and how much income they want to generate and how long they want to generate it for. Then there's other factors like legacy aspirations. How much wealth do they want to leave to their loved ones? And finding a way to distribute the income that they need without actually running out of money before they do. So when we talk about retirement, income. There's a lot of things to take into consideration. How long you'll be retired, and that's going to have an impact on your inflation of your retirement income. If you are buying gas today, it's going to cost more 20 years from now than it does today because of inflation. Well, that's a big factor in retirement income as well. What about stock market volatility? As your portfolio goes up and down, that's going to have an impact on your retirement income. One of the two biggest expenses for retirees is taxes and healthcare costs. But then there's the sequence of distribution risk. You may have heard of that risk. And what that is it shows that if a retiree has market losses in their portfolio in their first several years of retirement, the chances of them running out of money are exceptionally greater. But then there's the big daddy risk of them all. And it compounds all these other risks and makes them even greater. So that big daddy risk is longevity. The longer your retirement, the more risk you have of running out of money because of greater inflation, greater periods or more periods of volatility, more time to pay taxes, and the greater healthcare costs, especially at the end of your life. And so that's why retirement is such a tricky animal. It really is a science. It really requires a lot of planning, much more so than the accumulation phase of retirement planning.
Yeah, you're scaring me, Keith. No, longevity, we don't know how long we're going to last. And so we really don't know how much we need. But I think you're going to help us with some more statistics here.
Yeah. So how do we generate retirement income? Well, if you work with most financial advisors, and I'm not picking on anyone in particular, they're going to use something called the safe withdrawal rate. And what that means is how much can I take from my portfolio every year without running risk of running out of money? Back in the 90s, they were saying you could take 8 to 9% every year without running out of money. So if I had $1 million, I could take out $80,000 to $90,000 from my 401k without running risk out of money. Well, that's laughable today. We all know that that's ridiculous. Today, we're actually talking about it being more like 2 to 3%. Now, this slide shows it at 4%. So if you have $1 million portfolio and you have a retirement of 25 years or more, you could safely take out, somewhere between $20,000 and $40,000 a year without running out of money. But there's some problems with this type of theory, aren't there?
Mm.
Your investments are going to go up and down in value over time. And so if your portfolio has a market decrease, that's going to adjust the amount of income. So one year you might get 40,000 and the next year you might get 35,000. And many retirees don't like that difference in income. They want to know how much income they're going to get every year. They don't like to see that change. The other problem is that the safe withdrawal rate doesn't take into account inflation adjustments. So normally, if you're getting, $40,000 on top of your Social Security at age 60, that spending power is going to look differently when you're 80. So really this is a big problem, and there's lots of ways to generate income, and there's a lot of strategies to do it. And what we like to do is we like to tell our clients that we can safely get them 5 to 6% distribution rate, and that's also plus inflation. So that income should be able to grow over time. And we do that using investments that are not correlated directly to the stock market for retirees. What we do is we use investments that do have risk. I mean, every investment has risk, but so does leaving your cash in a bank account. Anything you do with your money has risks. But what we do is we have our investments in what we consider to be somewhat safe investments that are not correlated to the ups and downs of the stock market, and get increases in income from an inflation bond. So as we think about, well, let's go back. So as we think about the way that we do it at Wealth Teams, we use alternative investments, we use private capital, which are loans to businesses, and we use real estate loans to help our clients generate income. We also use treasury bonds. And what we do is we use a variation of what we call the bucket approach. The bucket approach will break your retirement dollars into 3 different buckets. And the first bucket is just going to be straight up AUM. It's going to be equities versus bonds. And we're just going to let it sit for however long it needs to sit. And it's going to go up and down in value, but we're not super concerned about it. But the other 2 buckets we use to generate your income. So we're using the second bucket, we're using a combination of private capital, and then also the first trust deeds, which are real estate. And we're using that to generate income. And in the third bucket, we have Treasury inflationary protection securities. And if your TIPS account is withdrawn at the end of 20 years, we'll just use that first bucket, that AUM bucket, to replenish the TIPS. If your retirement lasts long enough. So our clients have done this for 15 years or more, and they just love this method. They like this consistency of income. They like the fact that their income grows. But, as we think about retirement, think about retirement like a smiley face. You're 60 years old and you retire. And what do you do? What's the first thing that a lot of retirees do, John? They travel. They buy that big honking RV.
Yep.
Looks like Jim wants to say something. What's up, my man?
No, that's it. Or they get on a cruise that keeps going for 365 days.
There you go.
Yeah.
They live on a cruise ship. They buy the boat. They spend a lot of money. They're excited. They have a little bit more energy. They're not working anymore, so they spend a lot of money. And we call those the go-go years. But then as they age, they start to slow down a bit. They don't play tennis every day like they used to. They stay home a little bit more, and they go to the doctor more. Their outings become going to the doctor. But they're not on their deathbed. They still have a quality of life where they're able to visit, but they're not quite as active. And we call those the slow go years. And so think of it as a smiley face. Your income is up here, and then your income kind of drops because you're not doing as much anymore. But then comes the end of your life where retirees are facing increased medical costs. Maybe they have a long-term care scenario, and their income or their expenses continue to creep up. And it's like a smiley face. So your expenses start up here, and then they go down, and then they slowly come back up because you're spending more money on medical costs. We call that the retirement smile. And that end of your life is the no-go years. So what a lot of retirees end up doing, Joan and Reza and everyone here, is they spend so much money at the beginning of their retirement that they don't have enough for the end of their life. Or maybe they do, but they don't realize how much their long-term care is going to cost. And they have a lot of sticker shock, and they're reluctant to go into a long-term care because they don't want to spend the money for it. So the question I want to ask all our guests, whether you're here tonight or you're watching the recording, is are you confident you're going to have enough retirement income to pay for the rest of your life, for maybe the last 3 to 5 years of your life?
And this is why we're here tonight, is to learn about how important that is, first of all, but also how important it is. This is not the kind of thing you can do for yourself. You need a professional that can help you set up the right plans based on your goals and protecting your assets. I learned a lot already just in our discussion of this, getting this set up.
Yeah.
So thank you, Keith, for doing this.
Yeah.
So what's next?
Yeah. So what exactly is long-term care? Well, long-term care is not strictly medical care. It's not rehabilitative. It's basically just maintenance for your life when being cured is no longer really a viable option. You know, you have dignity as a human, and a long-term care policy is going to pay for your care in a facility or maybe even at home when you're no longer able to bathe yourself, dress yourself, you know, move from one place to another, or feed yourself, or maybe you need help on the toilet. Or maybe you have developed dementia and Alzheimer's and you need full-time care for that. And so long-term care is something that a lot of people say, I'm never going to need that. I've worked out all my life. I've eaten healthy. I'm never going to need it. But is that the truth? Here's some stats for you. 70% of people who are age 65 or older will require some form of long-term care throughout the rest of their life. And it's especially pertinent for women because they have a longer life expectancy. So my grandfather died in March, and he never really met the criteria for long-term care, but now my grandmother does. She's 85 and could qualify for long-term care benefit if she would have had a policy. Unfortunately, she doesn't. But if the message is that if you think that you're not going to be in a long-term care scenario, you're probably wrong. We don't
And
like
that's,
to, we
go
don't
ahead.
like to think of ourselves as being so vulnerable, but the reality is this has to be addressed one way or another in your retirement plan.
Absolutely. That's why everyone needs to consider long-term care insurance. And I know the next slide's going to make that really drive that home.
So here we have a slide that talks about the amount of claims for different types of insurance policies and how often they actually pay a benefit. So most of us are probably homeowners. Maybe you just bought a home recently, like some of my friends here. And you all have homeowners insurance. But out of 1,200 policies, there's only one claim being paid due to a fire on a homeowner's policy. 1 out of 1,200. Not very frequent, but we all have it. We all have the homeowner's insurance or renter's insurance. Well, if 5 out of 1,200 auto policies end up making a benefit payment, if you have a car, you pay that, every quarter, and you have the policy and you either use it or lose the benefit. If you're in an accident, you get the benefit. If you don't, you've paid the premium. But that's very infrequent as well. But then moving up the ladder, we have health insurance. So out of every 1,200 health insurance policies, there's 105 claims. So now we're talking, it's increasing quite a bit. It's a little less than 10%. But then when we get to long-term care, we see that out of every 1,200 policies, there's 720 benefit claims. So we're talking about a significant amount of people who actually receive a benefit after buying a policy. I think of my old partner, Bob, and his mother-in-law bought a policy in the mid-90s. And she paid for it for years and years, and it got to the point where she couldn't afford the policy any longer, but she was this close to getting a benefit. So my partner paid for the policy, and then about 6 months later, she actually went into long-term care, was there for several years, and ended up passing away. So again, if you don't think that you're going to be in a long-term care scenario in your retirement, that might happen, but probably not. So whether you have a policy or not, your retirement plan has to account for a long-term care event.
Yeah, pretty scary. I'm picturing that famous painting with the person's that's called The Scream. It's like, oh my gosh. So what is
So
this 2.2 years?
yeah, so these are some numbers that you need to know. And I bet some people here know what these numbers are. 2.2 years. Well, that represents the length of time on average that a man is in a long-term care situation. So you could probably deduce what 3.7 years is, can't you?
Yeah, it's going to be women. Yeah.
Right. So women typically are in a long-term care situation 1.5 years longer than men.
Hmm.
But this third number presents a problem. 3 years is the typical length of time that most long-term care policies will actually make a payment. It doesn't have to be that way, but that's how most long-term care insurance agents sell their policies. And but that's a big problem. And that last number is why. 5.8 years. You want to take a stab on what that is, John?
That's going to be Alzheimer's and dementia
Right,
because it comes in before you would normally need to
right.
stay. Yeah.
So my great-grandparents died in the early 2010s. My great-grandfather, who was one of the best people I've ever known, died in 2009, and my great-grandmother died in 2012. They were married over 75 years,
Oh gosh.
and my great-grandma developed dementia, and they were both in long-term care when they died. And her care, because she was a dementia patient, was substantially more than it was for my great grandfather because she required a higher level of care. And she was in a long-term care facility for 5 years. Because the way dementia works, and I'm no medical expert, Reza here probably knows quite a bit more about it than I do. But the way dementia and Alzheimer's works is it takes your mind, but you're relatively speaking, it's not going to have as much impact on your body. And so you might be physically okay, but your mind is going to be unable to know what day it is, and you're going to forget to do things, and so your body might last you a really long time as your mind continues to go further and further downhill. So it's very common to see dementia and Alzheimer's patients last 5 years or more.
And dementia costs more. Memory care costs more than if you're not in memory care, right? So
Correct.
what are we looking at for expenses for staying in a assisted living or whatever?
Yeah. Well, let's answer that here in a minute, but I want to talk about one more thing. I want to talk about the financial risks that a long-term care event presents to a retiree. If you haven't planned for this event, you're going to have some significant unplanned expenses, and that's going to deplete your savings potentially. You might be a middle class individual, maybe you're 65 and you have $500,000 in a 401k or an IRA, and that might sound like a lot, but in reality, it's not. But it also might impact the life of your spouse if you need long-term care and they don't.
Mm-hmm.
All your retirement income might go to you in your long-term care scenario, leaving very little for your spouse. So let's talk about the costs.
Yeah, that's not good.
It's a lot,
Enough-
it's a
yeah.
big sticker shock for a lot of people, isn't it? Let's talk about the different options here for long-term care. The primary difference between assisted living and nursing facility care lies in the level of medical care and assistance provided. Assisted living is for individuals who are primarily, they can live somewhat independently. Maybe they need someone to help them with some light, household tasks and chores like washing the dishes or doing laundry, but they typically have their own apartment in a larger facility. Whereas a nursing care facility is going to be suited for individuals with chronic medical conditions or disabilities who require 24/7 supervision. Um, and so they're going to, in a facility or in home care, they're going to provide you with, assistance with your activities of daily living that we previously mentioned. And so a lot of people want to stay home and receive that kind of care. That's not always possible, but but a lot of people want to do that. But there's a problem here, isn't there, Joan?
Yeah, absolutely. No one's got that kind of money.
Right, right. Well, but what about the costs in the future? Because the cost of inflation on this care is pretty large. And so in about 20 years, those costs are going to be doubled.
Oh, man.
And if you're a 55-year-old couple or individual in good health, you shouldn't be worried about the cost today. You should be worried about it in the future.
Yeah, if you don't have the money now, you certainly won't then.
And if you have, let's just say that you, as a married couple, you have, $45,000 of Social Security, and you have $1 million in retirement accounts generating $60,000 of income. That's about $100,000. And is that going to cover the cost of these facilities 20 years from now? So what is driving the cost increases? Well, it's a couple different things. My parents' generation, the baby boomers, are aging. By 2030, all baby boomers will be 65 or older. And that's going to drive up the demand for these kinds of services, which will increase the cost. But there's also a shortage of healthcare workers, which will increase labor costs. But another factor is increased technology and care. We have a great healthcare system that is improving the longevity of our lives. But with that comes a period of time at the end of our lives where we might have a longer period of time where we need care. So, those numbers we talked about, men needing long-term care for 2.2 years and women needing it 3.7. I expect those numbers to actually increase just because of advances in healthcare.
Yeah.
So, clearly this is a problem that has to be addressed. But, some people say, oh, well, my Medicare will pay for it. Will it? No. Medicare is supposed to be short-term rehabilitative care. My grandmother was in a rehab facility earlier this year, and when she wasn't ready to come home from an emotional standpoint, but from a care standpoint, she was ready. And so Medicare stopped paying it. She had to pay for it out of pocket. She came home very soon thereafter, as
Yeah.
you might imagine. Um, Now, if you are a person with very few assets, maybe you own a home, have a car, and live on Social Security, you might be able to have, receive federal and state funding through Medicaid or Medi-Cal to pay for it. But there's a couple problems with that. The first is that they might not fund a type of a facility that you would be comfortable going in. But there's a second problem. If you are a homeowner and you pass away having received Medicaid, they're going to come and recoup their costs when you sell your home and your estate goes through probate or goes through your trust. They're going to recoup their costs after you pass away. So it's not free, even though you don't pay for it during your life. And if you have legacy aspirations and want to leave assets to your children and grandchildren, that may eat up all your legacy that you might otherwise leave. So, so it's definitely a big issue. So what is your plan? Retiree, if you're 55, 50, 55, 66 or 65, what is your plan to pay for long-term care? We know that it's a big chance that you're going to have a long-term event throughout at some point in your retirement. Well, here are some options to discuss. First is self-funding. Now, for folks who have a great deal of assets, say several $1 million or more, you might just say, well, I'll be able to pay for it out of pocket. And you probably can. I've talked to wealthy families who are worth $25, $40 million about their long-term care. And I agreed with them that they could self-fund it. But I didn't try to pull the wool over their eyes and sell them a policy they didn't need. But they felt that having a policy made a lot of sense because, quite frankly, it was an emotional issue for them. They weren't ready to they didn't think they would actually be willing to pay for it when that time came out of their own pockets. So for them, having a policy makes sense because they're just going to let the insurance policy pay for their care whenever they meet that criteria. I know several people who are very close to me who definitely meet the criteria for receiving a long-term care benefit. They're uninsured and they refuse to go into long-term care because of the cost. They could pay for it, definitely, but they refuse to do it because of the cost. And so now their children their child and their spouse have moved in with them to help care for them. Is that what you want? Most people would hopefully say no. But then there are traditional long-term care insurance policies. These have really evolved and progressed over the years. The features of a traditional long-term care insurance plan will cover the costs, typically with inflation protection, which means that your benefit will grow once you start receiving the benefit with the cost of inflation. It's going to have, if you get it and when you're younger, say in your 40s or 50s, it's going to have a lower premium than other types of policies. But you got to know that with these traditional long-term care policies, there is the chance that the premium will increase. Matter of fact, it will increase over time. But with that being said, there are some tax advantages that Joan's going to talk to us about in a few minutes. The second type of, or third option for your long-term care are hybrid long-term care policies. Now, hybrid long-term care is a combination of both long-term care and life insurance. But the focus of these policies is on the long-term care rather than on the death benefit. It's going to give you a low death benefit, but with more long-term care benefit in the event of a claim. Now, if you never have a claim on long-term care and you pass away, then someone else gets your death benefit. The benefit of these types of policies are the guaranteed premiums for long-term care. But you need to know that it is going to have a higher upfront cost And any long-term care use from these policies will reduce your death benefit. So how is that different than a life insurance policy with a long-term care rider? Well, whereas a hybrid policy focuses primarily on the long-term care rather than the death benefit, the life insurance is going to focus on the death benefit. And if you were to use the long-term care rider, you would actually end up, reducing the death benefit. Because what it is they just accelerate you receiving the death benefit to pay for the long-term care. The downsides are that these do have higher premiums than other types of policies, but it will give you a larger death benefit in the event that you die without using the long-term care. And then the fourth option or the fifth option are annuities with a long-term care rider. These are really good for folks who may be older and want to have some long-term care protection, or they are not able to qualify based upon their health. Maybe their health is too poor to qualify for any of these other types of policies. Well, annuity would have very little health underwriting. But as you think about these different options, there are some things to consider. Your health and age, and your ability to qualify for these different types of plans. Your budget is going to vary, and so one person may want to do one option over another because of budget constraints. So Joan's going to talk to us right now about the tax savings for long-term care planning.
Thank you, Keith. It's just been really driving home the importance of knowing what your options are and having someone that you trust that can help you choose the right plan. But as you're doing that, you want to think about your tax ramifications. And so there are deductions when you are amortizing. I'm sorry, not amortizing. What's the word? Oh my gosh. Schedule
Itemizing.
Itemizing. Thank you. Oh my gosh. Yeah, when you're itemizing on your tax return, so you've got a house, you're paying real estate taxes, maybe some charity as well. Then your health, you can write off a portion of your health expenses, medical expenses, and also medical insurance premiums and LTC, long-term care planning. Those premiums are considered health premiums, medical premiums. So you would add that to whatever you would put on your itemizing. That's for individuals, and it's based on your age. So the older you are, the larger a deduction amount you can take for your premium. So when you're in your 70s and you're paying a lot more for a LTC plan, you can add that to your other medical costs and write off a portion of those on your itemizing. But the real advantage, tax advantage, is more for owners of companies. S Corps, for instance, they can automatically deduct these qualifying expenses, but it's still based on age. But the best way to go is with a C Corp, because a C Corp is going to provide medical and LTC and sometimes even life insurance for the owners of the shares, the owners of the company, but also for employees. And it's 100%, the premium is 100% tax deductible. So when you're talking to clients or you're talking to friends and relatives that have a business, they can afford the long-term care plan because it can be
Right. So, with these
deducted. The premiums can be deducted as a business.
Yeah. So with these types of policies for tax deductions, if you're a business owner and you have an employee that you maybe want to give an extra benefit to, perhaps getting them a long-term care policy would benefit for them. you're going to be able to get a tax deduction for the premium, and they're going to get a tax-free benefit in the event of a long-term care event. So
Right.
let's talk about a couple little case studies.
So we have some case study help to illustrate how it works. And the first one is for married business owners. So, the best deduction is for if you have a business. So let's say you're in your 50s and you're just starting out with your benefit when you claim is going to can be as high as 9,000 a month. In 20 years, that's going to be important because right now it might be 4,000, but in 10 and 20 years, it's going to be double for sure. So that's important to have that kind of coverage. Your annual cost now, starting now, is only 3,500, but your tax deduction is almost the whole amount if you have a business and you put that through your business as a business deduction. So this is why it's so important to have a business, but to know what you can do. But if you're in your 50s and you don't have a business, then your deductions you can see is quite a bit less. Do you want to do case study number 2, Keith? Or
Yeah,
is it?
well, before we get to that, I'll just say, I mean, a lot of people say, oh man, this is going to cost me over $3,500 a year. That's a lot of money. And they get that sticker shock. Oh, I can't afford that. But for the business owner or that taxpayer who does itemize their taxes, that, can you afford $3 a month after you get a deduction for the premiums?
Absolutely. That's
I would hope so.
Yeah.
And this benefit is just, or this case study is just an example, but that's going to pay, $9,000 a month per individual in a married couple, and that's going to be a max benefit of about 650,000, which is going to last you about 3 years for $3 a month.
Wow.
How does that sound, Reza?
Unbelievable.
Isn't it something? You really, if you don't know these numbers, you don't realize how really important it is.
Yeah, let's go to the next example. So here we have a married business owner couple, age 61. So their benefit has grown to 14,000 a month per individual with a total benefit of 1.35, which is going to last you about 4 years if you do the math. But because they're in their 60s and no longer in their 50s, their deduction is significantly greater, which means that their policy after the tax deduction on the premium is going to cost them about $27 a month. Still very affordable.
Yeah, absolutely.
But the thing you need to know is it has to be the right kind of long-term care. It can't just be any long-term care policy. It has to be a qualified one.
Mm-hmm.
So here's a third case study. Why don't you tell us about this hypothetical scenario, Joan?
Well, let me see. It's kind of, by the way, I just wanted to mention if you have any questions, you can put them in the chat. We'll try to get them answered. So this is kind of a way of looking at the hybrid version of a long-term care policy. And so let's say we have a couple, John and Mary, they're both 55, they're in good health. So it'll be easier for them to get this coverage. And their goal is to protect their assets, but they also want to plan for long-term care. So this is where having a professional that can help you achieve your goals, because everybody's got something a little different. They actually have some savings. They've got $500,000 in savings. They want to set aside 100,000, thinking that's going to be enough. And that's what they do. And so there's a way to do that. And Keith can explain it better than I can, the way to do that. But you're setting that aside so that it earns differently and it's protected, so that your tax benefits are better. And
Yeah.
Keith, can you get into
Yeah,
that?
so let's talk about how this hypothetical scenario, these two 55-year-olds in good health, they're going to pay $100,000 towards a hybrid plan. Now, just to refresh your memory, a hybrid long-term care plan is a combination of both life insurance and long-term care with the focus on the long-term care. So if you look at the benefit here, they're going to have a benefit starting at age 55 of $5,000 a month. So that's what it would pay in the event of a long-term care scenario. The total benefit at age 85 is going to be, double the amount. But in the event that they were to pass away without receiving the long-term care benefit, they're going to receive their heir is going to receive $120,000. So, but let's talk about the cost. They're going to pay $10,300 a year for 10 years, and then they're going to keep the policy for the rest of their life. But during the course of their of paying this policy, they're going to get a $4,700 tax deduction because this is a policy for an individual every year for 10 years. So really, in reality, this policy is going to cost them about $56,000 with a total benefit of $790,000 at the age of 85. So it does come with that sticker shock. Hey, this is going to cost me $100,000, but you end up paying, roughly a little more than half, but you have the potential of getting significantly more in benefit. I really like this option. I think this makes a lot of sense for the right individual.
7 times more. Insurance companies.
Yeah.
Yeah,
So it
they know
makes a
how to
lot
do
of
that.
sense for the individual who can pay a little bit more into the policy than with a traditional.
Yeah.
You just got to know that the benefit in the event you don't use it is going to be less than with a life insurance.
That's amazing. So that's a hybrid. So what about the other kinds of coverage, this annuity?
Yeah,
kind of-
so annuities, as I said before, are really good for folks who don't qualify for a traditional long-term care hybrid or life insurance policy because of age or health. And typically, you're not able to get a traditional policy once you're past the age of 70. But maybe say you're 72 or older and you have some annuities sitting around. You might be able to use those annuities to and change them over or trade them for a new annuity that would be able to pay for your long-term care without the health underwriting. And the primary benefit is that you have much less qualification to get an annuity. It's not nearly as hard, but if you get the right type of annuity with a long-term care rider, it's going to pay out the annuity payments tax-free for qualified expenses. Well, the primary benefit of most annuities is the ability to delay being taxed on any growth. So you're going to put the money in, it's going to be, tax delayed, and then you're going to get a tax-free benefit for qualified expenses. That's a great benefit. So, if you are someone watching this and say, hey, I have some annuities, I've had them for a while, I don't know what to do with them. Maybe it makes sense to take some of that and just move it into a new annuity so for your long-term care plan.
Mhm. And if you don't, it doesn't matter if you've got it, whether you have an annuity or not, everyone needs to consider long-term care insurance as a
Well,
way.
like I've said several times throughout this presentation, everyone has to have a long-term care plan.
Yeah.
There are different options, but there has to be some sort of plan.
Yeah.
And that really brings up a good point. When is the magic time for someone to consider how long-term care fits in their retirement plan? I would say it's somewhere between 50 and 55. Once you're 70, unless you have some significant cash or annuities sitting around, it's probably too late. So, if you're 50 or 55, this is the best time possible for you to figure out your long-term care options. The earlier you plan, the more options you have. And I don't know about you, Joan, but I like options.
Oh, yeah, absolutely. I always want to know all the options. What about starting sooner, like in your 30s?
It's
There's
possible. Yeah.
is the break even is at 50, would you say? Or there's a break even for every age, I would imagine.
Yeah, I don't know exactly what that break even would be, but the benefit of getting one earlier, for the first thing is that it's going to be easier to qualify.
And
And,
afford it.
it'll be affordable, sure. But for younger folks considering a policy, it might make sense even now,
Mhm.
even more so now. Several years ago, Washington State started a extra payroll tax to fund a state-provided long-term care program. The nation's really kind of looking at Washington to see what happens. And I've got to tell you, there's all kinds of problems with this. What they did was they instituted an extra payroll tax that everyone has to pay if you're a W-2 employee. But the problem is that they gave a certain period of time for a blackout where you could purchase your own policy to get an exemption from this extra payroll tax. Well, what happened was there was a flurry of people looking for a policy, and that really ended up steamrolling underwriting, and they couldn't get the policies out fast enough. And California today, if is one of the states that is considering instituting their own publicly funded program. Washington State's max benefit is about $35,000. So if you qualify for a benefit in Washington State under their state provided program, it's about $35,000, which is very, very little. But California is now considering instituting a plan, making the potential payroll tax twice the amount or more than Washington. And, all of this is just speculation. All we know is what they're discussing. We don't know what's going to happen, but they're actually saying, hey, maybe we won't offer a blackout period because we don't want to, stir up all the underwriting problems that we saw in Washington. Maybe we'll just say you'll have had to have a policy retroactively before the state funded plan is instituted. So in other words, you would need to get one now in order to avoid paying the extra payroll tax in California. What other states will do is really up for debate, but there are other states other than California considering their own plan. The reality is that a lot of these states are having to fund, these older folks without a lot of savings, and they need to find a way to cover the cost, and this is how they're wanting to do it.
Kind of like Social Security / long-term care.
Exactly.
Yeah.
But
Yeah.
again, 35,000 is very little benefit. That's going to last for a very short period of time.
Mm.
And if you live in California and you're paying this payroll tax for several years, and then you decide to move out of state, that benefit doesn't follow you. That stays with the state. So if you're looking for, ways to reduce your taxable
Man,
income,
we've learned so much.
take advantage of business owner deductions, maybe considering a policy for yourself, a family member, or an employee makes a lot of sense. So that's all.
It's almost like if you're underfleeted, right? The younger you are, the easier it is to get it as an individual. You get up over 50, and you're gonna wish you had a
Right. Yeah.
C
So,
corp that would help pay for those premiums and have it all tax deductible, right?
well, I always say that it may be tax deductible. It really depends on the type of policy and your age and a whole host of factors. But thank you for attending. I hope that this has been enlightening. I hope that
Yeah,
you're motivated
I really appreciate it.
to figure out what your long-term care plan is. I would be honored to help you with that. You're welcome to reach out to me directly or schedule a phone call using my Calendly link in the QR code and put a time on my calendar. I'm very pleased to have served so many people, and I'd be proud to help you.
Thank you very much, Keith, for doing this. Clearly, you care about people hearing about this and knowing about this, and not just so that you can have more clients, but just that people need to know about this. And I'm so glad you. Thank you for including me as well, so that I can tell all of my tax clients, that this is important. This is something that everybody needs to think about, even if you're in your 20s, like Daniel. So, so
Yeah,
thank you again.
yeah. Thank you. And that's all we have for today.
We are just under 1 hour. Thank you very much, Reza, and everyone for participating. And we'll just stop our recording and say goodnight. Thank you again, Keith.